What's going on, everyone? Welcome back to another episode of Fear Free Passive Investing. My name is Lucas Miller, host of this podcast, host of the YouTube channel Fear Free Passive Investing, and thank you so much for tuning in. We have a really great show today, but before we get into that, we got to talk about something a little personal. I'm flabbergasted the amount of people that are actually listening to this podcast. It's incredible to see the growth that has happened this month alone. I thought last month was great, and the month before that I thought was great, but January is on track to be the best month ever, and it's just incredible the amount of support I'm getting. So thank you so much for listening. It really means a lot to me, and I hope you're getting value from it. If you are, go ahead and leave a review on iTunes. It means a lot to me. And if you don't have an iTunes account, and that's okay too, just go ahead and send me an email. I would love to talk to you and love to hear your feedback. Lucas at bannoccapital.com, BANNOCK capital.com. All right, well, let's get into the show today. Today we have Chihiro Kurokawa. Chihiro founded Black River Equity Partners in 2017, and after 2 years of hard work, he finally closed his first deal in Abilene, Texas. He followed that up very shortly with a 248-unit property in Dallas, and he spends a lot of time thinking about risk. And we're going to talk about his strategy, but this is one of those things that I hear a lot about from passive investors is I want to avoid those deep value-add deals. Well, Chihiro's going the opposite direction and actually focusing in on those deals. So we're going to talk to him about why he likes those deals better than the more stable vanilla cookie cutter deals. So with that, let's jump into the show and introduce Chihiro. Chihiro, welcome to the show, man.
Hey, good morning. Thank you so much for the opportunity, Lucas. I appreciate it.
Yeah, so we've been friends for a while now, and I got to say, the reason I wanted to have you on the show is, of course, you have all these great experiences that I want you to share, but also, you just have this positive energy. Every time I talk to you, every time I see you, you are just emanating with positivity and like encouragement. And it's just so refreshing in this industry when everyone's so pessimistic about, finding the right deal and making sure they're not getting screwed. You're out there just, you're making it happen. You're being happy and you just have this awesome mindset.
Well, thanks. That I really appreciate the kind words. What's there to not be happy about? I think it's really invigorating, really exciting to be an entrepreneur and to do that within commercial real estate and apartments specifically there's just nothing to be upset about. Now it's really difficult and there's a lot of challenges involved, but I'm following my dream, so so I am very happy about it, and I appreciate the kind words.
Yeah, so you have such a unique story too. So for those who don't know, like your whole background and your whole story about, well, why don't you just take us through maybe a 30-second bio of where you've been and how you got to this point?
Yeah, going back to 2016, I had just gotten engaged to my now wonderful wife, Kristen, and I was working a corporate job where I still am today, and I was thinking, all right, how am I going to support myself, Kristen, owning a home, children, and then affording college, and then retirement after that? How will I be able to achieve that given the constraints that I'm facing today? And I felt like just relying upon our two corporate incomes wasn't going to cut that. And so I began a research phase back then in 2016. And in the beginning of 2017, decided I was going to become a multifamily investor, of course, not knowing almost anything about multifamily at that point, but that was the determination that I made. And so fast forward 2 years, it took of really, I would say, pretty decent amount of hard work. But fast forward 2 years from that point, and then in March of 2019, I had finally closed my first real estate deal, which is a 128-unit apartment in a tertiary market called Abilene, Texas. And so since then, I formed a team. We have a firm of 3 people, and we closed a second deal, which is a 248-unit in Dallas. So really, it's a story of having faith that this thing was going to work. and putting all the time, effort, and money into that pursuit and being very relentless about it.
Yeah. Yeah, definitely. And I think I met you when you were going through the closing process of that, and it took a long time to close that first deal, right?
That's right. Yeah, good memory, Lucas. Yeah, it was a 4-month escrow period. We extended, I believe, 3 times.
Yeah, gosh. And so a lot of people, and I'm sure you know this too, but a lot of people come into this industry, they think they're going to be multifamily investors. And then this hard work that you were talking about comes and hits them in the face, and then they give up. But like what I was saying earlier is you have this positive energy. You knew it was going to happen. And it took you 120 some deals that you underwrote before you found that one, right?
Yeah, it was a large number in the triple digits. Yes.
Yeah. That's crazy. Okay. So you decided, okay, I need to support my family. I've got all these expenses coming. I got to become a multifamily investor. How'd you get started? I mean, that's a scary, daunting task for a lot of people. How did you educate yourself on this? How'd you get up to speed and get to the point where you felt confident to make offers?
I love the question, Lucas. So it all starts with a desire, right? Like, oh, I want to have multiple streams of income, or I want to be financially independent, or I want to afford this or that or the other, right? But everybody has desire, and yet not all people achieve or fulfill that desire, right? So that's the first part: is do you have that burning spirit in you? And then the next step, if you're going to pursue something like multifamily, is okay, well, are you going to put in the effort to educate yourself, right? And that part of it too, I believe, is it's largely free. You have amazing sources of knowledge, such as your podcast or any number of other podcasts or any number of books or relatively inexpensive conferences that you can attend to learn a whole lot and absorb a whole lot of book type of knowledge, right?
Yeah.
For example, Rod Khleif has a book that, at least at the time, was completely free. So I just downloaded it from him. It was like a PDF book that taught me everything from A to Z about multifamily. But there's the but is is that book knowledge isn't enough, right?
Yeah.
So you start with the desire, then you execute on that desire to gain the knowledge so that you can speak the jargon and all that sort of stuff and understand what a cap rate is. But then if you're actually going to be a syndicator, if you're going to sponsor a deal, then you need way more than that. And so you probably relate to this. Like, you meet somebody at a conference or a meetup, and they might be at the desire phase, or they might be at the educating phase, or they have educated themselves, and you can sense that there's a fair amount of naiveness about what it actually takes to be a general partner on a commercial real estate deal, right?
Yeah. I had that naivety too. I mean,
And I did too. Exactly.
I think it's just something you go through too.
Exactly. And so for me, um, for over a year, I was pretty well educated from podcasts and books and whatever. But really, what I required to get to the next step to actually doing it was hiring a mentor. And that's what I did.
Yeah. And
Yeah.
that's so critical. And you and I share a mentor, which is, how we met, of course. But and I think there's this misconception that, oh, if you have to pay someone for education, it's a scam. And, I looked at it as more like I'm cutting the learning curve in half, if not even further. And especially, I was wasting my time, unlike you, doing house flipping and buying residential real estate. And, I was all over the place. And that really gave me clarity like, okay, this is what I'm going to laser focus in on. And it seems like you had that from the get go.
Um, yeah, so dating back to 2016, I was researching, or what can I do to diversify my income sources and increase my overall income. And the first place I went was single family real estate,
Mm-hmm.
whether buy and hold, wholesale, flip, whatever, right? I researched those topics and read some books and listened to Bigger Pockets and that sort of thing. But I came to a certain conclusion, which was that scaling was going to be very difficult with that type of real estate investment. Because I have a corporate job, right? So suppose I'm going to wholesale, right? I decide that I'm going to do that. Well, time is of the essence, right? You get a lead, you have to act on that right now. Okay,
Yep.
well, I get that lead at 1:30, but I have a 2 p.m. meeting. I'm not going to leave the office to go close that deal, right?
Right.
So I had to find something where a good portion of the time that I invest in that activity was going to be before and after work. And with multifamily, I was able to do that.
Yeah, that's good. I think when you look at the urgency that you were talking about, deals fly off the shelves in residential or wholesaling or flipping, whatever it is, and then you look at multifamily where it's a much more calculated approach. There's
Mm-hmm.
more people that are operating businesses that have the same constraints that you do. And that's what attracted me to it, is just that it's much more business like.
Agreed. And what you touched on there, Lucas, is this is a commodity. Housing and houses and apartments are commodities. And so I'm not going to have more deals than you because I'm smarter than you,
Mm-hmm.
or really anything other than, if I'm going to do more deals than you, it's going to be because I freaking work at it.
Yep.
And so the great equalizer in this commodity industry is effort, and there are, of course, certain elements of scale. Like if I've got 5,000 units, and brokers are going to be more likely to call me than if I have 300, right? But at the end of the day, the great equalizer is effort. And I love that, because people like you who put a lot of effort into this are going to rise to the top. And if you stop at the desire phase, or if you stop at the education phase, or if you don't even make it through the education phase, guess what? You're not going to be where Lucas is,
Yeah.
right? It is
Yeah.
that's what it boils down to.
I, that's so funny, because over the last year or so, I've just been going through this realization that everything in life, no matter what, it's almost universal. If you want to succeed these days, it doesn't take like luck, it doesn't take money. Like those things help, right? Of course. But what really sets it apart is consistency and really grinding it out. And the people that are putting in the work day in and day out and not getting tired and not getting bored and not straying, those are the people that are successful.
Yes,
And that's part of the
absolutely.
reason. That's part of the reason I went to 2 days a week for this podcast. It's not because, I had all this extra time that I was looking to fill. It's just like, no, I just want to be successful. I want to reach as many people as I can. And this is what it takes.
Yeah. Have you heard of a book called The Slight Edge by Jeff Olson?
No,
It
but
is
I
a
will.
wonderful book. You got to write this down. The Slight Edge, Jeff Olson. So my partner Hunter Jarvis recommended this book to me, and I devoured it, like read it in, I don't know, a few days or something.
Okay.
But the concept is quite simple, because as with apartments, it's not complex. It's just really difficult, right?
Mm-hmm.
It's a simple enterprise. Well, the concept in the book is also simple, which is every little decision you make has to be geared towards a philosophy, or you might also call that your why, right?
Right.
And every single decision has to be geared towards that. And generally speaking, almost invariably, any decision that you have to face is relatively easy on the effort scale of things. Like, so what I mean is, after this podcast, I could go play video games, or
Yeah.
watch a movie or something, or I could underwrite a deal, or reach out to a broker,
Uh-huh.
or whatever that's oriented towards my business, right? But writing that one email to a broker is like a 30-second effort, right? But
Yeah.
as long as I'm keeping that philosophy in mind of, oh, well, I'm working towards a goal or goals, and I put every decision through that prism, then I could be like, okay, I'm going to put this minimal effort in to do this 1, 2, or 5 things, so that I'm moving the boat for just a tiny bit towards that goal.
Hello, fear-free investors. My name is Tamil Kenny with Think Multifamily. I want to invite you to attend an incredible event, our Passive Investing Summit in Los Angeles, California. Whether you're an investor looking to diversify and protect your assets, or you like to create cash flow and build wealth, this is a can't-miss event. To find out more information, head to fearfreepassive.com/LA and use promo code Miller100 for $100 off the event. We'll see you there.
Yeah, that's a great. I'm looking forward to reading that book because that's the philosophy that I have. And James Clear has a book like that too. I forget what the name of it is, but his philosophy is being like 1% better, right? If you can just be 1% better every single day, it's not a lot of effort, but it adds up, you know?
Yeah, that's 365% in a year.
Exactly.
Yeah,
exactly.
and compounding is the eighth wonder of the world, right? So don't think about and this is covered in the book too, but it says don't think about compounding strictly in a financial sense, but in an effort sense too. Like if you could improve even 0.5%, 10 basis points a day, that's 36.5% in a year.
Yeah.
Right?
Yeah.
Like before compounding, that's 36.5%. So it's just about making those small decisions, being conscious of what the consequences are of any given decision. And then if you approach your life through that perspective, it makes it easier.
Yeah. Well, I want to move on because I want to talk about
Yeah.
the meat of our conversation today, which is you are now focusing on potentially one of the most controversial, strategies in multifamily investing, and you are going after deep, heavy value add deals. Can you explain the philosophy on that and what that is?
Yeah. So let's start with what it is. So I feel like a lot of focus right now in multifamily investing at the non-institutional level is Class B and Class C value add. And generally, those are stabilized deals. So those are deals that have 90+% occupancy for at least the last 90 days. And the reason that is in such high demand is because that is one of the major qualifications for getting so-called agency debt, right? Mm-hmm. And so those are generally the best debt terms that you can get on multifamily. So naturally people gravitate towards it. So they want to chase apartment assets that fit that box. Well, as you pointed out, we specifically went after something outside of that box for our most recent deal, which closed last year in 2019. So why we did that is a function of our interpretation of where we are in the market. This is the longest economic expansion period in the history of the United States, well over 10 years at this point. So I love the fundamentals of apartments, the fact that we as a country make far fewer houses than we need to, and the houses that we make are too expensive for the people that need housing the most, right? So what does that mean? That means continued demand for apartments, right? That's really one of the biggest reasons why you and I do apartments, right?
Right.
But then within that, if I want to be successful and survive through whatever economic downturns are in our future, because it's not a matter of if there's a recession, it's a matter of when. It will happen. We just don't know when it's going to be, how long it'll be, or how bad it'll be. So if I want to survive that, then strategically, I want to approach something that is going to have more upside so that I will be more insulated from any weakness in the market. So I can be more insulated from rent softening or occupancy going down, or both of those combined, or cap rates expanding, any number of things that would happen in the macro economy that is completely out of my control. I want to mitigate that. And so I made a conscious decision. We made a conscious decision as a firm to acquire assets that require greater value add, or you could call it a distress deal, heavy value add, whatever you want to call it, a greater upside deal, so that there's just more room for improvement, as opposed to a stabilized deal that might already have relatively decent looking interiors and exteriors. Well, ours needs a lot of work, right? So there's so if people are willing to pay say $600 a month for this place that's kind of a dump, well, if we make this dump into a place that's much nicer, much more livable, well, then the residents' willingness to pay is going to be greater, right?
Yeah.
Relative to a place that's in much nicer condition where they're paying $800 a month. Well, if you put some money into it, are they willing to pay $950 a month? That seems to me intuitively to be a bit more of a stretch.
Yeah. Yeah, that makes sense. It's all about equity, right? You try and just build up as much equity as you can, as quickly as you can, because that's what's going to carry you through any sort of downturn.
Yeah.
I know on
Thank you for putting it much more succinctly than I did. Yes, you're exactly right.
No. And I know on your first deal, right, you took a loan term that was a little bit lower loan to value because you wanted to ramp up that equity, right?
Well, the first deal was actually a stabilized deal, and because it's in a tertiary market, we had 65% loan to value. So it was a higher, equity to debt ratio, but that was just because it was a Fannie Mae pre-review market, so they were never going to give anybody buying out there 75-80% leverage.
Well, I mean, you could look at that as a bad thing, but I see it as a good thing, right? When I'm looking at deals now, it's like, how quickly can we add this equity? Just exactly like what you said, because if our valuations tank, if we're not getting the rents we want, I want to have as much buffer in there as we can to carry us through some of this stuff.
Exactly. Yes. Agreed.
Yeah. So I'm sure you're talking to investors now and you're explaining this strategy. I can see how someone who's just starting out, maybe, or has only done these agency deal debts, getting them to passively invest in one of these deals might be kind of difficult. How do you tell them? How do you, essentially mitigate their fear for them?
Yeah, I appreciate that question, because that is literally something that I talked about with prospective passive investors a number of times when we were raising capital for that deal. So the way I look at it is there are different types of risk. And so for this discussion, like, we'll talk about systematic risk, which we mentioned a little bit, right? Like occupancy going down, an employer in town shutting their doors, cap rates expanding, interest rates going up. These are all macroeconomic or other factors that we have zero control over, right? And then there's also other risks that I think are able to be mitigated. And so that might be something like operational risk, such as, okay, well, there's clearly more operational risk in leasing up a 75% occupied apartment complex than buying a 90% occupied one and bringing it up to 95. So then, as a passive investor, I think it would be important to think about, okay, well, is this sponsor who's pitching me on this deal, how are they equipped to mitigate risk, like mitigate operational risk specifically? So then at that point, I would look at the team, right? You have 3 newbies who are on their first or second or third deal running this deal, or are there sponsors on that deal who have been real estate investors for 20 years, been through the Great Recession, and they basically just know what they're doing and know how to operate a deal like this? So that, I think, is critical, because to a passive investor, I think that shows that the operational risks are being mitigated, And with a heavy value add deal, the systematic risks are being mitigated because there's so much more upside on that deal relative to a
We talk about
stabilized
that.
one.
We talk about this on the show a couple times, but every single investment deal you will ever make has variables, lots of variables. Some you can control and some you can't control. Our goal as the sponsor is to eliminate as many of those confounding variables that you can control as possible, so you get to a point of comfort. You'll never be able to eliminate all the variables, right? World War III could start tomorrow. You could have a, whatever, gorilla get loose and tear out all your windows or whatever it is. Right? You
I
can't
love that
control
one.
that stuff, but choosing a management company that has experience doing deep value add lease ups, you can control that. And so it's just
Right.
knowing what you can and can't control and getting the right members in the team. And it sounds like that's what you're focusing on.
That definitely is our philosophy right now. And so World War III, right? Suppose that happens tomorrow.
Yeah.
On a stabilized deal, what I'm starting to see more and more of is sponsors using short-term debt. So they're using bridge debt on a stabilized deal because cap rates are so low that they can no longer get agency debt at a leverage that makes the numbers work for their investors. So that's one thing that's happening. And so if, suppose, World War III breaks out tomorrow, that deal just has so much less margin, whereas on this deal that we're talking about, this heavy value add deal that I did, we just need to make this like a decent, safe, clean place to live. And these residents are so tired of the way things were when we bought it that they will reward us just by paying like close to market or market rents. Right? We just need to make this from someplace that's bad into someplace that's good. But if you need to go from good to excellent, that's really difficult. And in the face of an unforeseen circumstance like a war or whatever, something crazy and out of your control, I like my odds with a potential higher margin deal.
Yeah, that makes sense to me. You touched briefly on the financing side. What does the financing look like on these deep value add deals that you're looking at?
Yeah, so we have a 3-year bridge debt, and it's bridge to permanent financing. So it's a bridge product that is designed to convert to Fannie Mae when the time comes. So what we've got to do is clean the place up, catch up on all the deferred maintenance from the previous owner, and then get it up to 90+% occupancy. And then at that point, we will refinance to Fannie Mae. Now, we've got to do that within 3 years, or we'll have to extend. So we negotiated / paid for the option rather to extend if we need to. And that's and it is a floating rate loan, but we purchased a rate cap. So you buy an interest rate hedging instrument, and that maxes out or that limits the max interest rate that you'll be paying. Now, right now we're in a extraordinary low interest rate environment with apparently no likelihood of rates going up because that rate cap that we bought was super cheap.
Interesting.
Yeah.
Okay. Yeah.
Now, by the way, I'll add that we're not geniuses for buying this rate cap. Like the lender requires it. They don't want our payments to balloon to 2x or whatever, because they know we'll be potentially unable to pay that. So they require for a floating rate bridge product like this, they require that you buy a rate cap.
Interesting. Yeah, I knew doing a rate cap was smart. I didn't know it was required, but that makes a lot of sense.
Yeah, I mean, it comes out of our pocket, but the lender, they're covering their butt by requiring us to purchase it.
Yeah. Okay, so say a new passive investor is listening to this, and they want to know a little bit more about what strategy is right for them. What resources could you point them to kind of help them get started in this? Say they know nothing. How can they get up to speed quickly?
Joe Fairless has a wonderful section on his website that is devoted to educating passive investors. I think that's a great resource.
Okay.
There's a bunch of books out there. One that I really enjoyed that I read a few years ago, or a couple years ago now, is Rod Khleif's book. I think it might be called Lifetime Cashflow through Multifamily Investing, something to that effect. It's going to be a similar name to his podcast, but in any case, it'll really tell you in broad strokes what multifamily syndication is. I found that to be valuable.
Okay.
And you know what's the easiest way to learn? Is like listening to your podcast or and any number of podcasts. That was and continues to be a great source of knowledge for me.
Yeah. Yeah. I think those are some good options. We haven't really talked about Rod Khleif on the podcast much, but he is a great educator. And so we'll link to all of that at fearfreepassive.com. So just to wrap things up, if you were to give someone some advice, they're on the fence about passively investing in real estate, what sort of advice would you give to them?
I would say that let your fear of missing out, so your FOMO, that's got to be less than your fear of losing money. So you have to make investment decisions based on how that offering is positioned to mitigate loss of capital, right? So your fear of losing money has to be greater than your fear of missing out. Like if your friend, told you, oh my gosh, I made 2x in 18 months on this multifamily syndication, you got to invest with these people. Don't let that FOMO drive your decision.
Yes.
Like you have to educate yourself sufficiently that you can assess risk properly and understand what the business plan is and what the risks are and what the opportunities are. So that would be my number one suggestion.
Yeah, that's a very analytical approach to that. I like that. That makes a lot of sense.
Cool. I let that drive my decisions every day. So,
cool. Well, Chihiro, I really appreciate you coming on, sharing your story, talking about these deep value add deals and why they're so attractive. Where can people learn more about you and what you're doing?
Yeah, our website is blackriverep.com. That's Black River, E is in equity, P is in partners.com. And if they sign up on our very basic contact list, they'll get a free PDF that we have on our kind of basic thoughts on multifamily and why we do what we do and how we approach it. So that would be a freebie.
All right. We will link to that as well in the show notes. Chihiro, thanks again for talking with me on a Saturday morning too. You could be doing a lot of other things, watching TV, playing video games like you were talking about.
Yeah. I'm glad I don't have a video game system because in a past life, I used to play a lot of video games.
Yeah, me too. Like college. Oh man, I had to give it up.
Yeah. Yep. Exactly.
All right. Well, have a good one.
Thank you so much.